speaker, we will hear commentary remarks from perspective of OECD. So, please welcome Head of the Business and International Taxes Unit, Piers O'Reilly. He is working at the Tax Policy and Statistics Division in the OECD Centre for Tax Policy and Administration. So, Piers, welcome.
Can everyone hear me okay? Yes? Okay. So I'll add my thanks to Larry and to the foundation for this nice event. It's a pleasure to be here. It's my second time in Finland. My name is Piers, and I'm the head of the Business Taxes Unit in the OECD Centre for Tax Policy. So I lead the OECD's work on tax economics, essentially. So not the legal side of the OECD's work on business taxes, but more on the economic policy side. Following on from the very good previous presentation, I'm going to try and do three things in my remarks. First, to try and describe what has happened to corporate income taxes across the OECD in recent years. Then try to think a little bit about to point out some trends in the economy that might interlink with those corporate tax changes. And then talk about what should CIT design look like given the latest available evidence. So we saw that the evidence has kind of changed or been updating. Economists are learning more about the impacts of corporate income taxes on growth. And I think that the latest findings kind of challenge us a little bit to think harder about how we can design corporate tax policies in ways that actually work to support investment and work to support growth. So I'll talk about that presently. So just to take a step back about how kind of corporate tax economists typically think about the corporate tax system, I'll say at the beginning that the historical view, and it was very strong, it was a very strong OECD view, has been that corporate tax reductions work to support growth and investment, and supporting growth and investment is really important. Because it raises living standards, it allows us to pay for public services, it allows us to pay people higher wages, it supports all kinds of social benefits, right? So we said, okay, these things are important, so we want to reduce corporate income taxes, and corporate income taxes will definitely work to support growth and investment. And a little bit, this view wasn't very nuanced in the sense that it said kind of any kind of corporate income tax reduction was fine. Any way that you were bringing down the corporate income tax burden on businesses, that was okay. And this is something that is kind of no longer supported by the latest literature as we've seen. When we think about corporate income tax, and this is hopefully about as technical as I get, economists, we often think about two different kinds of corporate income tax rates that can affect business decisions in different ways, right? And this is the theory of corporate income taxes that is going to be important when I talk about some of the trends that we've seen. The first is the marginal corporate income tax rate. So that's how much corporate income tax is being paid over the life of an investment on an investment that is just about breaking even. And we care about these investments for a specific reason that I'll talk about in a second. So that's a marginal corporate income tax rate. And then the second one is an average corporate income tax rate. And so this is an investment that's earning what we call a more than break-even return. Another word is economic rents or supernormal profits, right? So some investments might just about break even, and some investments might do more than break even. And we can look about, well, what's the corporate income tax going to do to break even investments, and what's the corporate income tax going to do to earning investments that are earning economic rents or supernormal profits. And they're very different things, because if you levy additional taxes on a break even investment, there's a risk that you push that investment into loss. And if you say to the investor who is just breaking even on their investment, that, okay, well now with this additional tax burden, my investment is no longer profitable and I won't make it. And that's basically where this negative investment impact comes from in theory, right? But by contrast, if you have an investment that's earning supernormal profits, it's going to earn the investor a lot of money over the life of the investment, right? Then you can levy additional taxes without a negative investment impact, right? The investor will pay the additional taxes. They might not like it, but the investment post-tax is still worthwhile, right? And so when we try and think in theory about designing corporate income taxes, the standard thing has been to say, okay, well, let's set the marginal effective tax rate to 0, right? But let's levy positive taxes on super marginal or supernormal profits, right? And when we think about that, typically when we think about, well, what kind of margins are then affected, what kinds of business decisions are affected by the different tax rates, we typically say that they're different, right? Marginal returns impact the scale of investment, right? You have certain investments that if you levy additional taxes on the marginal return, the investments may stop, right? So you may get less investment if you levy a higher marginal effective tax rate. Whereas average effective tax rates impact location decisions. And that's especially important in an international context, right? That if you are a major multinational or a firm and you're trying to choose, should I invest in Finland, should I invest in Germany, should I invest in Sweden, should I invest in Ireland? You may have a project, an investment, a factory or R&D facility or a shop, anything. And it might be earning higher than break-even returns. And then you're trying to say, well, where is the best place to make that investment post-tax, right? And this speaks to the idea of tax competition, right? That I'm trying to figure out as an investor which jurisdiction post-tax will give me the highest returns, right? And that's where I choose to make my investment choices. So the marginal ETRs impact the scale of an investment, but average ETRs impact the location, right? And in theory, the economically efficient thing to do is to set the marginal ETR to 0, but the average ETR should be positive, because a positive ETR on investments earning economic rents should not impact the amount of investment we have in the economy. Rather, the burden of that extra tax should fall on investments that are making money anyway, right? Should fall on investments that are earning very high profits. So we might think that we might like those average rates to be high, but unfortunately, because of tax competition, it's those rates that have come under pressure, right? With more globalization and more mobile firms, it's those rates that have fallen. And we can see that when we look at corporate tax rates over the past 20, 24 years, 25 years across the OECD and globally, you can see basically the decline in corporate tax rates over that period, right? Within, I think the OECD is in blue, and then we have a series of other regions within the OECD inclusive framework, which we support. So corporate income tax rates have gone down, right? You see some stabilization here in the last maybe 5 years. The decline in corporate tax rates globally has started to level off, right? We don't know why that is. We speculate it may be because of reduced competitive pressures because of the OECD's FEPS work, or reduced competitive pressures because of the global minimum tax, which is coming into effect these days. But we do see this leveling off. But still, even with the leveling off, corporate income tax rates are much lower than they were 25 years ago, right? Turning just very briefly to Finland, comparing Finland's there in green. So Finnish statutory corporate income tax rates have also fallen by a lot since 2000. They're below the OECD average. They're also below other Scandinavian countries, Norway, Denmark, Sweden, which have also all fallen over the period. So with these falls in the corporate tax rates, the cost of capital has also fallen, right? So this is closely related to this idea of a break-even investment. The amount of return that you need to earn on an investment in order for it to break even has fallen a lot over the period from 2000 to 2020. This is a study done by some colleagues of mine at the OECD. And that's due to lower taxes. This decrease in the cost of capital is due to lower taxes, but it's also due to lower interest rates, right? So we know that at least in the period before kind of COVID and the war of Ukraine, interest rates were at historic lows. So this should be good news. This should be helping investors say, okay, well, in order to break even on my return on my investment after tax, I need to earn less and less, so I'll make more investments. This should have a positive investment response, right? And part of that response should be tax-driven because taxes have fallen. Even under more pressure than the statutory rates, so the previous chart I showed you was statutory corporate tax rates. Tax rates on intangible income are lower still, right? And so what do I mean by intangibles? By intangibles, I mean things like patents, things like trademarks, which are more and more in today's economy, they're a driver of economic growth, right? The largest and most profitable firms in the world, they're what we call intangible intensive. So when you think about large kind of tech companies, They're making their money not because they have a big factory or because they have a big plant or this kind of thing. It's really in the intangible stuff, the algorithms, the software. These are the patents, the ideas. These are the things that are making the money. And so more and more the economy is intangible driven, right? But these intangibles are easy to move across borders, right? So I was giving you the example before of a firm who's deciding to invest in, do I build a factory here or do I build a factory there? And that's going to decide where I generate my income, or do I build a shop there or a shop over here, or do I grow crops here or do I grow crops over there? Do I mine? All of these things are tangible. But more and more the economy is intangible driven, right? So now it becomes, well, where do I locate my patent, right? Where do I put my software? Where do I register a new drug? And those intangibles are really, really mobile, right? I can sell my patent from my Finnish subsidiary to my French subsidiary to my Irish subsidiary to my German subsidiary, and that's it. The economic activity has gone with the signing of a contract, right? And so because these intangibles are super mobile, the response to tax, so we saw that this average tax rate is what's driving M&E's location decisions, right? Because the intangibles are super mobile, the response to tax has been even stronger. Countries compete really acutely for these intangibles, right? And how do they do that? They do that through specific tax incentives that are designed to attract intangible income. Things like patent boxes, knowledge boxes, what we call intellectual property regimes. And so that's what we see in this chart. Here you see basically in black is the standard treatment of a tax of an investment on an intangible asset, right? And here what you see in the dotted blue line is the tax treatment under these IP regimes, these patent boxes, right? And so you see basically since again 2000, the scale of competition through these IP regimes has increased and increased, right? And so in the green bars there you see the difference, right? So the extent to which the tax benefit being provided to intangibles has increased and increased over time, right? So we're seeing regular tax competition for kind of physical presence, but we're seeing even more acute tax competition for on intangible income, right? So again, this is just another way in which we have competitive pressure of bringing tax rates down, right? And so what's the upshot of that in terms of how profits are taxed today? There's just quite a lot of low tax profit out there. So this is another study done by myself and some colleagues at the OECD, where we look at the total profits of large multinationals, and we try and look at, well, what is the effective tax rate being paid on that dollar of profit, right? So we're not really looking at investment decisions here. We're trying to look back at multinationals' profits that they have earned over the past 4 or 5 years, and trying to see, well, how much tax are they paying on each dollar, right? And we're aggregating here all large multinationals worldwide through data that we've gathered at the OECD. And what you see here is basically the dollar amount of profit. This is billions of dollars. And then the effective tax rate being paid on each dollar, right? And we can basically see that we have a lot of multinationals paying tax kind of at the statutory rate in a given jurisdiction. So the average statutory tax rate in the OECD is about 22%, 21%. Some countries have higher tax rates. There's a lot of profit being taxed at those tax rates, but there's also really a lot of profit that's being taxed at very, very low rates, right? Including at zero. So there's quite a lot of zero tax profit out there in the world, and even aside from zero, there's quite a lot of low tax profit out there in the world. And that's a function of basically the tax competition effects that we saw in the previous slides. So this kind of, I'm going to talk about what this means for growth in a second. But I want to just also point out that when we think about this, we know that these rate reductions, these CIT reductions come at a revenue cost. We know that they cost corporate income tax revenue, right? When people pay less, there's less revenue, but there's other impacts, right? There's impacts throughout the rest of the economy, there's impacts throughout the rest of the tax system. And specifically what I want to show here is changes basically in incorporation over, again, this same period, the period from 2000 to 2020. And why do I care about incorporation? Because I care about what taxpayers are doing in response to lower corporate income tax rates, right? And what do I mean by that is what we can see is more and more taxpayers are choosing to incorporate to benefit from the lower corporate income tax rate, right? So I'm a taxpayer, I have a small business, I can register as a sole proprietor, I can pay personal income tax on my business. Say I'm a plumber, say I'm a dentist, say I sell cookies, whatever it is, right? Or I can incorporate, set up a business, and instead of paying the personal income tax rate, I pay the corporate income tax rate. And I only then have to pay a personal income tax rate whenever I distribute a dividend to myself or whenever I sell my business and pay capital gains tax. But the larger the gap between the corporate tax rate and the personal tax rate, the more and more the incentive is for people to incorporate. Right? And that's what we see has happened. So basically the dark blue bars are the share of taxpayers that are incorporated, that are paying corporate income tax. And you see in a lot of countries, we didn't get all of the countries in the OECD for this survey, but in a lot of countries, basically the amount of incorporated taxpayers has increased very sharply, right? And so something that that gets talked about when you talk about corporate income tax sometimes is people say, well, the rates are going down, but the revenues are not falling. So we're doing something right. But the problem is a lot of that revenue is actually recharacterized personal income tax revenue. It's taxpayers that would have been paying a tax on basically a wage, but are now paying a lower tax on business profits instead. Right? So that means that the decline in revenues that you experience when you cut corporate tax is not confined to your corporate income tax base, it can also affect your personal income tax base. Right? So this is knock-on revenue impacts that we don't measure a lot of the time. So, turning then to growth, so we saw corporate income tax rates were declining. We saw there were particular declines for mobile profits. We saw that the cost of capital has fallen, so that means there should be more investment, right? And we can see it's coming at a revenue cost. So then what have these changes bought us? And the answer appears to be not very much, right? So this is investment intensity in the OECD over the same period, last 20 years. And we are not experiencing a global investment boom. Now again, it's important to say correlation is not causation, right? So there could have been other factors that have been dragging on investment that would have meant that, if we hadn't cut corporate rates as much as we had, maybe investment would have been even worse, right? But this kind of story aligns with the story that we just heard, which is that, corporate tax rates, they don't seem to be generating the positive investment and growth impacts that we might have thought that they would, right? And this is a problem, right? I mean, stagnating investment is a big problem. But also, if you look at, this is IMF work, if you look at global growth, right, over the past 20 years, as well as projected growth, I think this last one is partially projected, we can see a decline. And importantly, we can see a decline in this red bar, which is productivity, right? And so productivity is the part of growth that's being driven not just by how much capital we have or how much labor we have, but how good we are at using those factors of production to generate economic activity, right? And we typically think of new corporate investments, new ideas, new patents, new innovations, new ways of doing business as driving productivity growth. And we think of productivity growth as being really important for overall growth. But we're not seeing an increase in productivity growth the way I might have liked, or the way we might have expected, given the scale of corporate income tax cuts that have happened, and given the scale of low tax profit that we actually have. So that's a problem, right? Then at the same time, what we also see is rising markups, right? So this. Essentially, this chart also is from a paper by Jan de Lucker that measures the extent to which corporations are charging more, or are selling at a price beyond what it costs to produce the good or service, right? So it's a proxy for the extent to which corporations are earning these economic rents that I talked about at the beginning, right? And the evidence suggests that the corporate economic rents are rising, right? And that those rents are accruing to firms kind of at the very top, right? That market concentration is rising, and that it's basically larger firms that are earning more economic rents. And this is a disputed finding. We don't know the extent to which this is happening, right? But there is some suggestive evidence this is happening. It's happening in Europe, and it's also happening in the United States. And this is a problem. Number one, because we've seen these declines in the extent to which we're able to tax away these economic rents, right? But moreover, there's also evidence that large corporations pay less than small corporations, right? Because they're better at tax planning, because they can shift profits, because they can engage in avoidance activities, right? So this then generates this worry that we have the very largest firms that are maybe potentially earning more economic rents. We have very large firms that are capturing more market share. We have very large firms that are capturing more of the rents that are happening in the economy. And these are the firms that we're failing to effectively tax. So if we were taxing economic rents effectively, those firms would be paying more money, but actually the evidence does not suggest that that's what's happening. So, just summing up before, how am I on time? Okay, that's enough time. So just summing up before I turn to kind of the policy dimension. So, theory suggests that lowering the cost of capital and lowering corporate tax in general should spur investment. Competitive pressures have done this for us, right? They've brought down the cost of capital and they've brought down corporate tax rates. It costs money. It costs not just corporate income tax revenue, but it also costs personal tax revenue. The investment impact appears limited, right? At a global level, the growth impact also from the earlier presentation also does not seem to be there. It's hard to assess the counterfactual. There's no alternative universe where the corporate income taxes didn't fall, where we could try, maybe investment would have performed even worse. We can't say. But certainly we have not experienced an investment boom that you might have thought you might have experienced when rates fell on average by about a third. And then at the same time, there's this concern there's a kind of an expanding literature on this that points to market concentration, points to kind of concentrated gains for firms at the top, and then that also suggests that these firms are paying less tax compared to other firms, kind of smaller firms across the distribution. And then that tax advantage is part of the reason why certain firms at the top are outperforming other firms. And this unlevel playing field between some firms and other firms is itself a drag on growth, right? So, given all of those trends, then what do we think we should do? How should we make corporate tax policy given kind of this context? So the historical advice from the OECD was to reduce CIT, as I mentioned at the beginning, right? This was based on a study we did in 2010 that's very widely cited. The subsequent evidence, so there's been a couple of other studies that basically try to redo that study with more detailed data and slightly more sophisticated econometrics techniques. And then there's the very good paper that we saw presented earlier, which is this meta study that basically doesn't suggest that this finding is not robust, right? Now the evidence on investment in tax is a little bit more robust. So sorry, I should say this is about tax and growth. The evidence on that reducing corporate income taxes does not robustly support growth. So at a macro level, it doesn't appear that you can reduce corporate taxes and impact growth, right? Or at least not in a simple way. The evidence on investment in tax is more robust. We know that lower tax jurisdictions tend to attract more FDI, right? So oftentimes in a lot of policy debates, I think including here, people say, okay, well let's cut my taxes and get more FDI, right? But we've seen before that the natural response to other jurisdictions is to do that as well, right? So it comes at risk. It comes at risk of the race at the bottom. It comes at risk of crowding out domestic investment. So if you get a lot of foreign FDI, it can raise prices and make it less attractive for domestic investors to make investments. And sometimes these foreign investments don't necessarily have these kind of multiplier effects that we talked about earlier, where there's a positive spillover to the domestic economy. You essentially provide a benefit to a foreign multinational, but you don't necessarily get these positive spillovers in your own economy. So yes, reducing corporate income taxes do robustly attract FDI, but it comes at a cost, right? It comes at a revenue cost, and then it comes with these other risks as well, right? We have some suggestion, although this is only one paper, that the investment response over time is falling. We don't know why that is. It could be because some firms are earning higher profits, so that they've made all of the profitable investments that they need to make. But it points to this kind of caution for a naive use of corporate income tax to support economic growth. The evidence also points to kind of a strong heterogeneity in investment responses. different taxpayers respond differently, right? So as you know, over the passing of time, we just get more sophisticated economic evidence. Smaller firms seem to respond more cash constrained firms seem to respond more. So this is important. So then in a recent paper, my colleagues, this is Hanapi et al., came to these three conclusions, which I think are probably our best current advice on corporate tax design. The first is to, if you want to try to use corporate income tax to support growth, what could you do? First is to try and think about the right instrument, right? So there are a lot of OECD countries that still levy what we call gross basis taxes. So taxes that are levied on a base other than corporate profits. They're business taxes levied on something other than profits. So they're levied on sales or they're levied on assets, right? These taxes are not efficient because they don't distinguish between whether a firm is profitable or not. They don't try and target the profits. They don't try to target the tax burden at high profitability firms. The next is to try and think about the right taxpayers. To try and focus the attention on smaller firms, on firms closer to these kind of marginal investment decisions, firms that might not be able to borrow or access capital markets effectively, so your tax benefit, can loosen their cash constraints and help them make more investments more effectively. And then try and support the right reductions. So we had this discussion earlier as well, is that rate cuts do not seem to be so effective at generating additional investment compared to other kinds of corporate tax cuts, notably cuts to the corporate tax base through investment allowances, credits, accelerated depreciation, immediate expensing, right? So those are still corporate tax cuts. They're still reduce the corporate tax burden, but the evidence suggests that they're more effective than cutting the headline rate. So this kind of economist, I guess, will never give you a straightforward answer about what to do, and I'm certainly no different. Some of that evidence suggests, okay, well, taxpayers respond very differently, so let's target the taxpayers who are most responsive, right? Or let's target the kinds of activities that we really like. And at the OECD, we're typically quite hostile to that argument, because we have for a very long time been of the view that broad bases are better, right? The target and tax incentives come with a lot of risks. We know a lot of countries in the OECD have a lot of tax incentives. Developing countries have even more, right? And it's because it's the easiest thing, right? You have a lobby group, wants support from the state wants to give something to the lobby group, so they give them a tax incentive, right? And those tax incentives, once given, are very, very hard to unwind, because as soon as the government says, okay, well, we need to earn more money, well, a given lobby group will very aggressively protest and try and protect its tax incentive. And that basically means when you give tax incentives to every group, then your tax base is much smaller, and you have to raise your rate, or you have to do something else to try and get the money that you need, right? And so we tend to warn very strongly against the use of tax incentives, even though we know that there are heterogeneous responses that might suggest that targeting tax relief towards specific taxpayers might be a good idea, right? This is a trade-off. It's not straightforward what to do. So, I mean, what are the risks? There's fiscal costs. There's windfall gains to certain taxpayers. You give a tax incentive to somebody who would going to make an investment anyway, and basically then you exacerbate these unlevel playing field issues, and potentially you give more economic rents to certain taxpayers that are earning profits that didn't need the incentive. You make the tax system more complex. I'm sure there are people from the Finnish tax administration who would prefer a less complex system. Taxpayers say they would prefer that as well, right? They would prefer a system that's easier to comply with, right? So that again speaks to the need for tax reform, but tax incentive reform is really hard, right? Broad-based systems are really better, but base broadening is really difficult. I don't know enough about Finland to speak to the breadth of the tax base. The Finnish tax to GDP ratio is a little bit below the OECD average, but so is the Finnish CIT rate, which suggests that the Finnish tax base is not noticeably narrower than other OECD countries, but it's not something I can speak to with authority. But all I would say is just base broadening is always something that is worth looking at. And then I'll provide one final piece of nuance, which is the only tax incentive that at the OECD we typically kind of robustly support are expenditure-based tax incentives for R&D. And it's the R&D tax incentives, especially those incentives that provide particular benefits in proportion to the amount of R&D expenditure that you do. So R&D tax credits is a typical example. R&D tax deductions also work. Are among those tax incentives that are most robustly associated with better taxpayer activity, and then also with positive spillovers to other firms, right? So innovations generated by one firm benefit other firms in the economy. So while we typically warn against tax incentives, even though we know there are heterogeneous responses, the exception to that typically is expenditure-based tax incentives for R&D. So that's more or less all I have to say. So again, it's really important to try and support investment and growth for a whole host of reasons. I think the latest economic evidence has made that harder, has made giving advice in that space for us harder, because it's not as simple as it used to be. We used to tell people to cut corporate taxes, and that advice doesn't seem to work so well anymore. But we do still think that there are things that countries could consider. Trying to look at removing taxes on bases other than profit, business taxes on bases other than profit where they exist. If you want to do tax incentives, to target them at expenditure, not income, right? To tie the tax benefit closely to the amount of additional investment a firm is doing, and to target them towards those taxpayers that we know are responsive, right? And then make sure that there is a good reason for every tax incentives that you're doing, right? So in the case of R&D, the evidence is robust, but if we want to think about other tax incentives, specific places, specific sectors, groups with a lot of political power, these things are really it's good to be very cautious about these. It's good to make sure that we're regularly evaluating these tax incentives, and that we know that they work, and that we know that they don't generate windfall gains for some firms, and that we know that they also generate these kind of positive spillovers, which is the justification for tax incentives. And then finally, we're in a world where it seems that a small minority of firms are capturing more market share, and that those firms are earning higher profits, right? And that it's important to think that statutory rate cuts directly will provide additional tax benefits to those firms more than they will to other taxpayers. And then they'll also contribute to this race to the bottom, which is generating risks of reduced taxation of economic rents globally. So with that, I'll stop. Thanks.
Thank you, Piers, for your commentary. Before we let Tuomas on the stage, one quick question. Sorry, Tuomas. You mentioned that evidence supports use of generous capital allowances over rate cuts. Do you know what would be the most effective ways to use these capital allowances? Are there some certain allowances that would be more effective than other?
Yeah. So I mean, in general, we prefer simple systems, and we prefer systems that try to avoid unlevel playing field issues between different kinds of taxpayers. So we tend to suggest that increasing what we call the baseline, the standard allowance, as opposed to kind of providing allowances for specific types of assets, or for specific places, or for specific sectors. That the simplest way to support investment is to provide an increase in the generosity of the baseline allowance.
Yeah. Okay. Thank you.